All right, we're also talking about this, fears about a U.S. economic slowdown that have sent stocks around the world tumbling. Nearly everything on Wall Street is down. The Dow opened more than 1,000 points lower. The S&P 500 and the NASDAQ are also down. Journalist Benji Heyer is monitoring the story for us from Washington, and he says weak job data from the U.S. could be behind the stock market uncertainty.
Well, the global stock market, in fact, has been in recall since late last week. That's when a jobs report landed here in Washington, D.C. from the Labour Department, which showed that there had been jobs growth in the month of July, 114,000 jobs created. The problem is that that falls short of the expectation that many economists projected of 175,000 jobs. Unemployment also slightly upwards. And whilst these changes between the prediction and the reality are pretty marginal, ultimately it pointed towards a trend that many investors feared would lead to a recession. And so we woke up this morning in the United States and looked across the world to see markets internationally in freefall. In Japan, the biggest sell-off in about 40 years, similar sort of pictures in Europe. And as you were mentioning, the moment that the opening bell went, the Dow Jones plunging 2.8%, the S&P 500 index sinking 4.2%, these the major indices in the United States, and the tech-heavy NASDAQ plunging 6.2%. For those that don't follow the markets closely, these are numbers that we haven't seen, or at least have rarely seen, since the economic crisis of the COVID-19 pandemic. That is sparking these sort of concerns that we've heard over the last couple of hours that the US economy could be moving in the wrong direction.
So some concerns, as you mentioned, but let's talk more about the significance and also the potential impact of all of these drops we're seeing.
Well, I think the impact is twofold, economic and political. So economically, if it continues to go in this direction, then there are some banks, JP Morgan, for example, one of the world's biggest banks, that fear it could lead towards a recession. 50% likelihood they put that chance at, because it would signal negative growth, and a repeated series of quarters of negative growth would put the US in a recession. There is still a lot of wiggle room, though, for the US's central bank, the Federal Reserve, to try to push borrowing, to push spending, and therefore to push growth that could lift the US economy out of any turmoil. Interest rates at a high rate of 5.5%, and the Federal Reserve has indicated that that could drop next month, and it may do so by a greater amount than initially indicated, in order to try, as I say, to boost growth and to boost GDP. Still, though, there are huge political implications, because the impact of that change might not come in time for it to have significant bearing on how many Americans think about the economy in relation to the upcoming election. Vice President Kamala Harris, who tops the presidential ticket, will have to stand on her record of the Biden administration. And if it stands as a record of recession, then that's not going to put her chances that's not going to put her in a very good stead come the November vote. Already, her rival for the Oval Office, former President Donald Trump, and the Republican nominee, has pinned the blame directly on the Vice President and, of course, President Joe Biden.
That's journalist Benji Heyer on that story for us in Washington. For more on this, let's bring in Jennifer Lee. She is a senior economist and managing director at BMO Capital Markets, and she joins us from Oakville, Ontario. Jennifer, thank you so much for taking the time to talk to us today.
No problem. Thank you for having me.
So a lot of discussion, a lot happening with this story. If you could break it down for us in the most simplest of terms, what's driving this sell-off?
You know, I think the overall driving factor right now is just expected slower than expected U.S. economic growth. I mean, we all expected the economy to continue to start slowing, and we've already seen signs of that. And it's totally to be expected. You know, after 525 basis points of rate hikes, something is bound to happen. And, you know, but the fact that the U.S. economy has continued to grow at a pretty solid pace, given everything, is pretty impressive. And I continue to say it speaks to the resilience of the overall economy. I mean, we saw 2.8% annualized growth for second quarter GDP, which was well above expected. And it was pretty much broad based. And yes, it is a look in the rearview mirror, but it's still, again, it speaks to the resilience of the U.S. economy. Now, lately, we've been seeing some signs of slower growth, again, to be expected. And I think what the tipping point was when we saw the manufacturing ISM on Thursday hit an 8-month low in the month of July. And then, you know, it was, as everyone's been talking about, the slower than expected U.S. payroll report. You know, we have to remember, by the way, that the U.S. is still creating jobs. There's almost all the big industries were still hiring, but just at a slower rate. Perhaps what's most interesting and a little bit concerning is that the other survey, the household survey, hasn't shown a heck of a lot of growth. And then we saw the jobless rate tick up to 4.3%. So I think that's what caused a little bit of overreaction, I like to think, maybe a bit of panic. What we saw on Friday, and certainly what we saw this morning with, as you just heard, with the Nikkei getting into bear market territory. But I'm going to quote our global investment strategist, the wise Brian Belsky, who said this is pretty normal after, a bull market. This little bit of this correction is, again, just the move toward normalization.
But Jennifer, some people are still panicking. So what are some of the factors that's really feeding into that panic?
I think perhaps there's talk now about the Fed, and I couldn't believe it when I saw this, but there's talk about an intermeeting move. And I think that, and so if that's the case, that would completely reek of panic. And I guess it's just slower than expected growth, recession, and that is not our base case scenario, although sometimes when we have reactions like this, you never know, it could become a self-fulfilling prophecy. So we have to be careful of that. But again, we still see, steady-ish slowing economic growth, just tapping on the brakes. And then we'll have to see how things play out towards the end of the year.
Let's look at other factors potentially playing a role in this chaos of the markets. How much of a role would the U.S. election campaign be playing right now?
I think we cannot completely dismiss that factor. I mean, there was some of the surveys, they talked to the respondents to see what's concerning them. And over the last few months, at least, we've seen the discussion about U.S. politics playing a role. So U.S. businesses, for example, could be a little bit more hesitant now to invest in something large, or buy a large durable good item, for example, or invest in one until they see who takes the Oval Office. And right now it looks like it's going to be anybody's guess. It's not as close as it once was. So we'll have to see who wins the election on November 5th, what kind of policies play out starting in January. I mean, we could see, the feared tariffs, for example, if we see a Republican White House, if we see Donald Trump taking the whole reins again, we can see a lot more tariffs being rolled out into the U.S. economy. And that could be bad news, not just for the U.S., but for the world as a whole.
Jennifer Lee, thanks so much for your time and your insights today. Jennifer Lee is a senior economist and managing director at BMO.